Okay, so welcome everyone who's on the call so far. We're about 3 minutes to, so we're just going to give it probably a few more minutes before we get started. Okay, so we are almost at time now, so we might get started. So I'd like to just start by saying good morning and thanking you for taking the time out of your day to be on this special webinar event. I realize all of you are very busy right now and there's a lot going on in our lives. So from all of us here at Ingram Micro, we do appreciate the time you're taking. Now I see in the webinar some of names that I recognize from the industry, from both the vendor and the business partner landscape. So welcome to you. And for those who don't know me, my name is John Brown and I manage the data center and security practices here for Ingram Micro Australia. So I'm just going to start with a brief agenda. Today we're going to be talking about the government stimulus and ways to optimize cash flow. Each topic will probably take about 20 minutes and then we'll have about 5 minutes for a brief Q&A. But what I would ask is don't wait to the end to ask your questions. On your chat screen to the side there, you should see an area for you to enter questions. So if you enter them in as we go along, we should have enough time to answer a few of them at the end. So my guest today is Cole Wilkinson of Pitcher Partners. Now, Cole works for a wide range of clients, from technology startups to large private companies to global corporations, and he specializes in financial management and business advice. So welcome, Cole. Maybe I'll just get you to chime in and introduce yourself.
Yeah, sure. Thanks, John, and thanks to yourself and Ingram Micro, obviously, for the opportunity to come and have a chat with you today on this. As I'm sure everybody that's on the chat today would know, it's been a pretty crazy time for businesses out there, and a lot of the focus for a lot of my clients has been on the government stimulus and obviously cash flow and getting through this. So it's pretty topical across pretty much every single one of my clients. As you mentioned, I work in that business advisory space, which I guess is quite broad, but covers tax advice through to cash flow, financial management, structuring, all that sort of stuff, for a pretty broad range of private companies. So we don't work with large sort of listed corporates and multinationals, or I don't certainly, but really those private businesses. But they do range quite a lot from startups through to companies that have still got international presence and certainly sort of global. So pretty broad and covering across a fair few areas there. So
I imagine right now you'd be getting a lot of inquiries in the current situation that we're in, and a lot of clients. There's probably a lot of uncertainty out there in terms of how to navigate the situation.
Yeah, certainly. Like pretty much our entire month of April has just been dealing with these inquiries. Most have been government stimulus related, but certainly there's been a lot broad other commercial issues that they're navigating at the current environment. So certainly been heavily focused on that, and as most people would know, things are changing very rapidly, or they have been changing quite rapidly. So it's really been a case of it's not a case of just having one chat to a client and that gives them all the information they need, because every couple of days something new comes out, something changes. So it's really been looping back around and making sure that everybody's got the most current advice necessary. So hopefully the timing of this, albeit some things have been out for a while, there's quite a lot of changes that have happened in the last week even, which can be quite relevant. So
yeah, and I guess that's the kind of uncertain nature of the situation, is that things are just changing so rapidly, and we're just sort of in this constant state of flux with announcements coming through from the government. It seems, multiple times a week in some cases. But before we get started, I should just mention to the people on the webinar that today the content that we're going to be covering is fairly general in nature. So before you make any decisions about your business or your financial situation, you should talk to a CPA. And I realize a number of you would have probably done that already. And, because obviously they can give you specific advice to your unique situation. But having said that, hopefully the information that we're going to be presenting to you today is going to be useful. And, I think with that, we'll probably dive straight in. So I guess I get that a lot of you on the phone have probably already established or worked out how to access the various financial support or components of financial support that's available. But we're still hearing that there's a fair bit of confusion around what people need to be doing, right? And just this week, as I've said, there's been deadline extensions. I know the JobKeeper payment deadline has been extended. So Cole, maybe I'll just get you to give us a brief overview of the stimulus in terms of what it means to business owners, but also the changes, importantly, the changes that people need to be aware of in this time.
Yeah, sure. So I guess I'll probably, there's been a lot of stimulus measures across that covers off on most businesses. I'll probably cover off and focus on some of the key ones, because that's certainly where the majority of the inbound queries have come to me. So I guess the first one, which is probably the simplest, is what the ATO refer to as the cash flow boost. So that's essentially where businesses can get up to $100,000 effectively, which that had changed. Initially it was much smaller, but increased to $100,000, effectively refunded from the ATO over a period of time. So the first sort of period was the March quarter, and so some businesses, quite a lot of businesses probably have already received that, and that was up to 50 grand. And then the other component is paid over 4 tranches, being from June through to October, so later on in the year. And that cash flow boost is linked to the pay-as-you-go withholding. So depending on the level of employees you have in the business, determines how much you got back there. The good thing with that is that it is automatic effectively. So most companies didn't have to go out and lodge things or change anything. It just happens automatically, but certainly something to be aware of. And hopefully, if you haven't got access to it, then you certainly should look into it and make sure that certain lodgements are done and up to date so that you do get access to that. The other really big one has been JobKeeper. And so as you mentioned, John, that the JobKeeper was announced a number of weeks ago, but there was very little detail on exactly what the criteria was until maybe 2 weeks ago. And then even then, there was quite a lot of businesses that didn't meet the basic test. And then they've released new information Thursday last week. So it's been quite busy just working through that. So just as a broad overview for those that haven't sort of dealt with it already, the basic test to access the JobKeeper to start with is effectively that you can demonstrate a 30% decline in your turnover from this year. So that could be a test period being the month of March, could be the month of April, could be the June quarter, for example. 30% declined compared to the same period last year. Now that makes sense for a business that's been around for quite a while. has fairly sort of steady turnover, and then they've suffered a decline in turnover because of COVID-19. But for a lot of my clients, certainly in the technology space, that's not how their businesses operate. They're either a fast growth type business or potentially have, other factors that come into play. Maybe they've commenced business during the year or undertaken a restructure. But that's the basic test. And then essentially the benefit that you get from JobKeeper is a payment that's equal to $1,500 per fortnight per employee, and per eligible employee, should I say. So I guess your comment at the start, John, about the fact that this is general and there's certainly you need to contact your own advisor, plays true here, because it sounds very simple on the surface, but there are quite a lot of finer details in terms of how you test certain things. When I say turnover, what does that mean? It's not necessarily the turnover that business owners would consider turnover. And so you do need to sort of consider every specific circumstance. So a typical question that I've had, from a lot of business owners, they look at their profit and loss and see, what their revenue looks like. But for a lot of businesses, their revenue may be different than the GST turnover that's used for this test, because they might have contracts that last 12-month period or something like that. They invoice and receive the funds for that up front. That would be considered turnover for this purpose, but that's very different than what those businesses might consider revenue, because it is over a 12-month contract or something similar to that.
Is there any flexibility, like when you mentioned they have to demonstrate a 30% decline in revenue based on a test period from the previous year? Is there any flexibility in terms of when the start of that period is and to when the end of it is? Like if you had a worse month in sort of April, February, March, April versus April, May, June, can you sort of evaluate the period based on that?
Yeah, so effectively you can pick and choose. Like you have to be, like under this basic test, you have to be comparing the same period from year to year, but you can essentially pick and choose. So for example, a lot of businesses, their month of March was actually really good leading into this for various reasons, but then April or May or June may see a decline. So you can sort of pick and choose what period. The one thing to sort of consider there is if you wanted to be eligible for JobKeeper back to the start of the program, which is the 1st of April, the only periods that can apply is either the month of March, the month of April, or the quarter, the June quarter, so April, May, June. And so effectively you can use the forecasted turnover for the June quarter and compare that to the June quarter of 2019. So either of those will allow you to claim it from the start. For businesses that may not have a decline until say June or July, you can use those periods, but you'll apply for those at a later point in time, and you'll only be eligible for the JobKeeper from the start of those periods.
Right.
So if you use June, for example, the month of June, then you would be eligible for JobKeeper from the start of June as opposed to the start of April. So there is a few options there. And like I said, or you mentioned at the start, actually, they've extended the time frame to do that first registration to the end of May. So for some businesses that are not that proficient at forecasting, they may have some hesitation about forecasting the June quarter and applying on the basis of that. So for those businesses, they might want to hold off until the end of May. So at least they might have a better idea on what their June quarter is going to look like. And, they can then make that assessment at that point and still claim right back from the start effectively. The other thing that you just need to be careful of is, I said $1,500 per fortnight for eligible employees. So you do need to have a look at what your staff base looks like and make sure that you sort of go through the test to determine who's eligible and who's not. Mm-hmm. So things, for example, like casual employees are eligible as long as they've been employed for 12 months and on a regular and systematic type basis. That's quite vague in some cases in terms of what that categorises as. There's also certain visas or a number of visas, the people here on certain visas that are not eligible employees.
Yep.
So you do sort of have to go through every employee, unfortunately, and check their circumstance to make sure that they're eligible. and then you get them to fill in a form effectively to hold on to that and make sure they're not claiming it twice. The other one to watch out for is it's a one-in, all-in type arrangement. So effectively, if you apply, you have to apply on behalf of all eligible employees. So even if there's somebody that you only pay, that maybe it's a permanent part-time employee, works 1 day a week, you pay them well less than the $1,500 a fortnight, they still need to be included, and you need to pay them a minimum $1,500 per fortnight to be able to claim. So you can't sort of opt in or out on different employees. So there's some of the sort of tricks, I guess, and traps, I suppose, to think about just in relation to the basic test. And then there was the alternative tests, I guess, which were released on Thursday last week. So that's probably the area where, you know, potentially a number of people on this call maybe haven't spent a lot of time or got their head around yet, because they're, it's only fairly new, and some of them are relatively complex as well. So I guess there's a numerous tests, but some of the key ones are whether if it's a new business, if you've undertaken a restructure, and you know, a restructure is pretty broad in terms of how it's covered, but you know, certain things like if you're restructuring entities, and therefore the entity that was carrying on the revenue or had the turnover last year is a different entity than you've got this year for whatever reason. Or you've acquired another business or sold part of your business, those sorts of things, then you may be able to look at other options. The one that I've been dealing with primarily has been the fast growth business. And so that one, the fast growth, effectively looks at a situation where a company has grown, and there's 3 tests you can use, but effectively they've grown by more than 50% from, you say, March last year to March this year, or you can use 25% over the last 6 months. So from September through to March, it's grown by more than 25%, or 12.5% in the last 3 months. So essentially what they're saying is, for a company like that, it's not really fair to compare, you know, March or April last year to April this year, because the business has grown substantially over that period of time. So what they've said is, if you pass that test and you fit within those that definition, then you can use the average of the last 3 months as your sort of test period turnover. So for example, if you're looking at April, then you can use January, February, March, the average of those 3 months as your test, and if it's declined by 30% to April, then you would be eligible effectively. So that's probably
interesting, because I don't know that everyone would probably be aware of that. You know, you have the ability to kind of look at different snapshots that way.
Yeah, and it's not like effectively the way it works is you can apply the basic test, you can apply any of the alternative tests. So for some clients, you know, that have experienced a decline, it's not necessarily very straightforward, and so a lot of the time we're applying all the tests until we find one that might work and fit within that client and how they sort of operate. So, and you know, the business maybe didn't increase 50% 12 months ago, but in the last 6 months it's had a really fast growth, and so you know, they might still fit within that test and then can use the 3 month average. Similarly, for some businesses, and I'm not sure, you know, if too many people on the call would have this, but is if their turnovers are regular, you know, so if there's certain periods that spike versus others. So similar sort of approach. Effectively, if you've had a 50% difference between the peak and a low month throughout the last 12 months, then you can fit within the irregular turnover test. And that is similar in the sense that you use the 12-month average as your sort of test period turnover effectively, and can compare that. So you never know, that sort of thing might fit in, and the restructure is probably the other one. So, and like I said before, you know, there's a numerous technicalities in a lot of these tests, and they're being clarified on a pretty regular basis by the ATO, but they're certainly not all clarified yet. So, for example, the term restructure it's not sort of defined anywhere. So they provided some examples, but it's not defined. So you do need to look at every situation and work out what applies.
So you'd probably anticipate that there'd be a round of other announcements, as we sort of move through into May.
Yeah, I mean, there will be, and not necessarily always announcements either. So one issue that's concerned us a little is the issue of using cash or accruals for determining your turnover. And initially, so none of this is in legislation, but from the ATO's guidance, initially they said that you can use cash or accruals, whatever you prefer, almost, which seemed odd that they just give you that option. They've sort of tightened that stance up a little bit, but they're just changing, via their updates on their website on a daily basis, basically. Yep. And so, the status at the moment effectively is more of a case if you report GST on a cash basis, then you can use cash. But if it's more appropriate to your business to use accruals, then you can use accruals. So little things like that can make a big difference if your, cash cycle is quite different to your actual sort of invoicing effectively, which can impact the turnover. So there are a few things like that which you do need to be careful of, but it's certainly worth, if you are experiencing some decline, it's certainly worth looking into it in a bit more detail rather than just on face value saying, well, it doesn't look like we decline compared to last year. Yeah, that would be my recommendation, is sort of dig in a bit and have a look around, because it might, you might be eligible, and for a lot of businesses it's very significant. $1,500 per fortnight per employee from essentially from the start of April to the end of September is a pretty significant amount. So yeah, it's worth looking into if you are experiencing some decline, but on face value you may not think you passed the test. It'd be worth looking into. So
I know, Cole, there was some components to do with subsidies for apprentices and trainees. Is there anything that's sort of valuable to mention in respect to that element of stimulus?
Yeah, I mean, it certainly is if you have those in the business. It was fairly limited, but and I, off the top of my head, I think it was capped at about 21,000 or something, and I think you get half back. So, but there were a lot of those specific measures, I guess, that came out. The other one, which I think got overlooked initially at the start, was the relaxation and changes to the instant asset write-off concession as well. Initially, a lot of businesses are in shock, and so this one didn't get looked at too much, mainly because people preferred to get the 50 grand cash in their bank rather than spend money. But now that we sort of move forward towards 30 June, for businesses that may be in a position to acquire assets, this is something that certainly should be considered. And so that's probably the next thing that we're going to work on with our clients, is looking at tax planning for the 2020 year. And I was talking to one of the other partners here this morning, actually, and he has a client that was looking into buying some equipment. And what they've effectively done is combining their strategy around acquiring this equipment, utilising these instant asset write-offs, which I'll go through in a second, along with variations to their pay-as-you-go instalments, which the ATO has come out and said, businesses can do this. And so what they've effectively done is had a look at their profit for the year, their expected profit, decided to go out and buy some equipment. And so essentially there's two elements to it. One is any piece of fixed assets, equipment, things like that, hardware that's under $150,000 per item can be written off immediately for tax purposes between now and 30 June. And also, if there's equipment that's costs over $150,000, you can get a 50% deduction of that prior to 30 June as well. So in this particular example, they wanted to buy some equipment that's worth about 130 grand, so they got a full tax deduction for that, and another one that was about $1 million, and they get $500,000 tax deduction for that. And so effectively, when they combine that together, that just about reduced their profit to nil for the year, or their expected profit. And so then they've gone and varied and claimed back any pay-as-you-go instalments that they paid to the tax office. because they're not expecting to have to pay any tax. And so then they've managed to get that cash back from the ATO, which has obviously then helped fund this equipment purchase. So just having a look at different strategies like that and how you can apply it to your business, particularly in certain sectors where they may experience a short-term downturn, but longer term, the business is fairly solid, and they are looking to expand, then taking advantage of this while you can is potentially beneficial, and looking to combine it, which might sort of flow into the cash flow in a minute, but looking to combine some of the other incentives that have been out there, such as the banking loans and stuff that's been guaranteed by the government. So that particular client's also combined it with, going and talking to their bank and obtaining some finance through this 250 grand guaranteed loan at a very low interest rate to help sort of fund this. So it's sort of strategies all come together to provide a pretty good outcome. So
yeah. So I want to move into cash flow, but I just thought I'd just ask one more question regarding the stimulus. I know that there's been a lot of focus and coverage on the federal stimulus, but what hasn't really received a massive amount of coverage is stimulus at a state level, and these are things like business grants and other forms of funding that's offered at a state level. Given we've got people from all over Australia, we probably won't be able to go into massive amounts of detail on this, but is there anything that you could touch on by way of support or how to access business growth grants that were probably available before any of this happened and are actually still available now? That might be relevant?
Yeah, sure. So I'm obviously based in Queensland, although Pitcher Partners, is based nationally. We're sort of got offices in all the major capitals, but I am based in Queensland, so I have more direct Queensland knowledge. But probably the first key area from a state-by-state basis is payroll tax. So payroll tax, initially some of the states came out and offered some deferrals of payroll tax, and then I think they started competing with each other on who had the best stimulus measures. So then they've effectively all got pressured into providing actual waivers of payroll tax. As far as I'm aware, most of these you do need to apply for. A lot of it's not automatic. So if you haven't already and you do pay payroll tax in different states, then it's definitely worth looking into that. So most of the states have given at least a 3 or 4 month waiver of payroll tax completely, plus deferrals, some through to the end of this year, calendar year. So it's definitely worth looking into some of those measures. A lot of the states have also come out and provided some other loan type schemes. So in Queensland, for example, they come out with a separate 250 grand government loan, up to 500 million was sort of the cap, and that has actually closed maybe a week ago. So obviously there's been a lot of companies that have got out there and accessed that loan scheme. Aside from that, that, like you mentioned, there are a lot of business grants and programs and stuff out there. All of those programs essentially are pre-funded, and I think at a time like this, people often forget about that sort of stuff. So I know there's been the odd grants and things out there, like I deal a fair bit in the growth business space, and accelerating commercialization is one of those. And I talk to people in those programs, and they say, well, people just have forgotten about us, because of all these other things going on. So yeah, I guess it's a case of, if there have been things you've been looking at in the past or that you've utilised, it would be worth, revisiting that, because sometimes, the demand for these is actually quite low because people forget about it and they look at these other more publicised measures. And so there's plenty of that sort of stuff out there at a state-by-state basis generally, some federal, but mostly state-based, that can provide assistance. So that's probably the main recommendation there, I guess.
Something worthwhile looking at, definitely. So I guess I want to switch gears and talk about cash flow, and we'll just sort of we're running a bit over time, so we'll spend about sort of 10 minutes on this or so, and then we'll jump into a Q&A. But Cole, what would be the process or steps that you take businesses through in terms of optimizing their cash flow, and what resources are available?
Yeah, sure. Yeah, so I guess there's a couple of steps that we sort of recommend. One is looking at their banking arrangements, I guess, is probably the first one, and it's almost, picking off the low-hanging fruit is sort of where I start with, so you can spend a lot of time working on cash flow and analysing it, but you start with the low-hanging fruit first, looking at your budgets and forecasts, and then the other one is looking at your expenses and more of a cost reduction type program in this sort of situation potentially. So the first one, just about banking, I think, and most businesses probably do this, but it's certainly a worthwhile time having that discussion if you do have bank facilities, and understanding what's out there. So for example, like we mentioned before, the government guaranteed bank loans that come through the bank, it's potentially worth looking into that now, rather than when the business is in trouble. It's a lot easier to get these things through when the business is still in a solid financial position, and maybe then you can use that to ride the storm out and come out the other side in a strong position. So things like looking at your overdrafts and making sure that they're suitable, I guess, for the business, looking at interest rates, looking at your merchant fees, if you do have like merchant fee facilities, and seeing what you can do there. So it's worth having a discussion on that side. Possibly, aside from the banking, which is fairly easy, the next thing I really recommend is looking at your budgets and your forecasts, and spending the time now to sort of reset that. I think it's been drummed into a lot of businesses out there, but there's still a lot that don't, how important it is to know your numbers and to go through this process. And when times get tough, it's even more important than otherwise. And so what I would recommend certainly is to have a look at, say, the next, 6 to 18 months. And if you've already got budgets and forecasts, then, maybe it's time to review those and reset them. But if you don't, then I think it's a good time to put that together. So at least, because I don't think the impact of this is going to be over and done within 6 months. It's going to last longer than that. So if you can sort of roll it out to 18 months or so from now would be good. And generally what we recommend is, putting together what you think your base case scenario is, running some, having some sensitivity analysis in there so that you can see what it's going to look like on a, best case and worst case scenario. And the other thing that I think is really important when you're looking at forecasting, and there's obviously, that's a whole topic on its own, but the key thing probably in this scenario is not just looking at your profit and loss, but also your cash flow. So some businesses do forecasts on a profit and loss basis, but cash flow in this sort of environment is probably, more important than that, or definitely more important, I would say, because you may well be still selling your products and your customers and all that sort of stuff, but whether you're getting paid in the same time frames that you were before, having a look at what your bad debts are going to be like, and running the sensitivity analysis on that, because obviously if you're selling product and you're getting paid a month later or 2 months later, well, that's going to have a pretty significant impact on your cash flow, even though your profit and loss is still looking pretty good. So that's probably what I would recommend there for businesses that are, seeing a more significant downturn, or consider themselves, in a bit more financial difficulty. Then possibly looking at like a weekly cash flow forecast over, say, a 12-week period would be recommended as well. So if the business is pretty strong, you don't necessarily need to cash flow, do your cash flow weekly, but if you feel like cash is pretty tight, then I'd recommend doing a weekly cash flow as well, just to make sure that you're, tightly managing some of this stuff.
So when you take a deep dive into, the cash flow of the businesses that you work with, and you look at kind of where the money is going and what's tying up cash, what are there sort of main areas that catch people by surprise, like that they just didn't know, the cash was being, because there's obviously the obvious areas, but there's also probably not so obvious areas that would catch people out.
Yeah, I mean, to be honest, I would say the areas that catch people out are the obvious areas, primarily. Okay. like it's a common question that I've had since forever, basically, and that's, you know, I'm making money, I'm growing, but I've got no money in the bank, no cash, you know, and so, you know, debtors and like trade receivables and inventory is probably the two key areas for businesses that carry stock. And, you know, so yeah, so receivables is probably the big one, and, you know, I guess looking at receivables in detail, understanding your business, understanding your customers, understanding what the drivers are is really important. And that's something that's quite specific to every business, you know. So looking at things like, you know, if you provide 5% payment discount by paying early, or things like that. If you know, some businesses might help if you provide a merchant facility for a client, so they're not having to pay manually or call up and pay with a credit card or something like that. Just having the ability to you know, run that through a payment gateway and get paid directly, you know, by clicking on the invoice. Sometimes that is enough to just improve those debtor days by, you know, 5 or 6 days, or avoid having to chase up people. So some of those strategies I think is worthwhile, you know, looking into, and, you know, just understanding what affects your customers, and, you know, if they can pay on a credit card and get a 5% discount, well, maybe that's all you need, and you can get paid quicker, and it means that you've got that extra cash to, you know, keep the business afloat, or to, you know, invest and grow the business.
Yeah, I know that credit card payments, you know, obviously you've got to weigh up the merchant fees, but depending on the product that you've got, you know, it could be up to 60 additional days, you know, 45 to 60 days in terms of additional credit. So if you have, you know, 30 days in a month and you add the other 60 days, you know, you're giving yourself a bit more oxygen from a capital perspective, from a working capital perspective.
Exactly, and, you know, I know for my clients that are paying us, you know, we're a business, we have the same concerns around debtors and receivables and all sorts of stuff. But you know, if we provide an easy way for them to pay with a credit card, in a lot of cases they pay much quicker, because it does give them that extra, you know, 45 to 60 days worth of cash flow, and it's easy, and the merchant fees is worth that to them. So so that's certainly a key one. Obviously, stock is also important, you know, in terms of managing that. You know, most businesses I find are pretty good. They know their stock fairly well, but, you know, obviously you want to, you know, keep that stock turning over at a reasonably fast pace. And so if your turnover comes down, then, you know, you probably do need to reassess that and make sure that he's turning over at the right sort of level. You know, they're probably the key things there. I mean, obviously, you know, the same applies from on the other side of the ledger. Effectively, businesses looking at their creditors, and same thing. You know, it might make sense to you to pay your creditors faster to get a 5% discount or something like that, and maybe that's worth it to you, and using the credit card on your creditors as well. So it's just looking at both sides of the ledger, I guess. The other big cash flow one at the moment is our friends at the ATO of basically banking the country at this point in time. And so the ATO have come out and said that I think in almost every case they'll provide a payment extension of any ATO obligations. And so that is up to 4 months, basically without any payments. So that's something that, you know, a lot of our clients have availed themselves of, because it's given them that extra cash flow. The ATO, you know, in this case hasn't required the same sort of analysis as what a bank might for that facility. So it's certainly worth looking into that, and whether you can manage ATO payments, knowing that obviously you still have to pay them in 4 months' time or thereabouts, but that might help as well.
Yeah, you've actually talked a lot. I mean, one of my questions was in terms of accessing cash. And we've sort of covered a fair bit of that. And I know the Treasury has small to medium, you know, business guarantee schemes to support 40 billion of lending into small to medium business. But are there other, and obviously all the unsecured loans, but are there other mechanisms that people can use that are sort of available to access cash at the moment that come to mind?
Yeah, I mean, through the banks and that government guaranteed facility is probably the key one.
Yeah.
It's, you know, like you said, there's 40 billion. And to my knowledge, I don't think that's been utilised a lot yet. So,
Right.
you know, I've only heard of a couple of clients that have actually gone and got that. You know, so that's probably one that I certainly would look at, because it's the rates are likely to be very good and the terms very good. And it's still a case, it still gets assessed on commercial terms to a certain extent, albeit favourable. So, you know, I think it's better to get it now if your business is in a strong financial position than wait until, you know, things maybe aren't as strong. If you're going to go look down that path, ATO is certainly one, is the other sort of area, obviously, of, you know, using that cash management. And I think it just has to be looked at as an overall strategy rather than looking at each thing on a piecemeal basis, is probably the main one. And then probably the last one, just on a, you know, looking at those forecasts, is really at looking through a cost reduction type strategy. And probably just, you know, I know we're sort of running out of time, but probably the key thing there, you know, the way we sort of look at it is identifying your costs and sort of categorizing them into a couple of different buckets. And, you know, so one would be considered essential costs, which is where they're costs that are where you're delivering value to customers, and there's often not that much you can do there because it's pretty critical. Another one would be sort of necessary costs, so that might be like rent and stuff, which is generally required, but it's certainly an area that you could look into. There are a lot of rental concessions and stuff floated around, which is somewhat state by state, but generally national. Yeah. And then the last two is sort of looking at your discretionary and, you know, more avoidable type inefficient costs. And so they're areas that might be things like sponsorships and, you know, obviously travel at the moment is pretty limited, so there's probably less of that, entertainment, stuff like that, which you probably can carve out fairly easily. And what we generally recommend is, you know, you assign, you know, the project, I guess, to look at and review these costs to those people that are mostly related to it. So, you know, for sales and marketing type costs, you know, you would probably allocate that to one of your sales managers or your head sales managers to go and review, you know, their budgets, because they know what they can cut, what they can't, to effectively sort of operate the business. Yep. So certainly go through that process, you know, reviewing your contracts and work out what you need, and look at other options, like I said before, about, you know, discounts based on, you know, paying in advance or payment terms and stuff like that. So, and, you know, that's a whole project to go through, but certainly it's worth having a look at internally, or same thing, talking to your advisors about it, and they can sort of help you work through that sort of cost reduction program. Yeah, that's something that's important.
So Cole, we're sort of at the 40-minute mark roughly. So what I might do is just dive into a quick Q&A.
Sure.
And then we'll do a wrap up. So there's a couple of, so please guys, ask questions if you feel like you would like to. So there's a couple of questions here. If an employee has liquidated paid leave in order to keep their salary and JobKeeper is backdated, does the employer have to give back the annual leave?
That's probably more of a HR lawyer question, but I wouldn't think so, is my personal view. But yeah, that's certainly, I mean, that's the other thing that's quite complex in this area, is the HR fair work and all those sorts of things, you know, with stand downs and, you know, cashing out paid leave. I wouldn't think so, because I think they would be completely separately, but, you know, I certainly would recommend talking to either somebody in your HR team or, you know, a HR lawyer, just to clarify any of those HR issues, because, you know, I think there's going to be a fair bit of fair work related issues through all this.
Okay. And is another one, if our forecasting of revenue shows a decline of a little over 30% and we apply, but actual revenue declines end up to be not so bad, can we opt out and refund without penalty?
Yeah, so this is another area that's a little bit unclear, but essentially what they've said is if you do a forecast and it's reasonable and it works out that your decline was not quite right and it was a little under the 30%, they essentially said you don't have to go and adjust it. You can still claim it anyway, even if you got it slightly wrong.
So there's some leeway.
There is some leeway.
Yeah.
That's basically the guidance they've given. It's what I've said. So that there's not a lot of guidance on that, what that means, but there is some leeway. If your forecast is completely wrong and you're way over, then, albeit they haven't sort of specifically come out and said this, but yes, you can essentially opt out and refund, the funds that you've received. And I highly doubt in this case there would be any penalty or anything like that, because you're acting in good faith effectively and in the spirit of the whole arrangement. So, and that's their catch-all at the moment. The ATO is saying, well, as long as you're doing it in the spirit of the program, then it's sort of okay. So it's quite vague, but that's their catch call, I guess. I've had a couple of situations where clients have received the cash flow boost automatically, but they're actually owned by a foreign parent and their turnover is too great to receive it. So we've actually contacted the ATO in those circumstances and said, hey, you guys have paid this, but we're not actually eligible. Can you tell us what you want us to do, and we'll refund the money? So haven't heard back yet, but so it's okay. I mean, if you think it's going to be borderline, you could wait until the end of May to lodge. That way you still get backdated to the start of April, but you'll be a bit more sort of secure on the forecast, I guess, at that point in time, potentially, unless obviously you need the money now. But
okay, well, thank you so much, Cole. Yeah, I've really benefited from this discussion, and whilst it's been a high-level overview, I think we've covered some pretty useful ground. Are there any sort of parting thoughts that you wanted to share with the team, or if they want to find out more information about Pitcher Partners or yourself, they can obviously probably reach out to you on LinkedIn?
Yep. So I guess three takeaways, I suppose, out of this is, the first one is on JobKeeper. Make sure, if you have experienced some decline, make sure that you sort of talk to your advisor or look into it yourself in a bit more detail, particularly these alternative tests, because there's a reasonable chance that you may fall into one, even if you don't feel like you meet the basic test. So it's definitely worth doing that. The second would be the overall tax planning strategy. So now's a good time. We've got 2 months to the end of the financial year. Have a look at your overall strategy around tax planning for the FY20 year, because you may have had a really good, 9 months of the year. Even if the last 3 months is not great, there still may be tax to pay. So have a look at that. Have a look at your tax instalments. Have a look at the instant asset write-off. See if there's things you can do as an overall strategy, along with everything else that's going on, to minimise that tax or to get a better tax outcome. And understand where your position looks like coming into the end of the year. And then the third one would just be around that cash flow. If you don't already, now's the time to take the time and prepare a forecast, budget/forecast for the next 6 to 18 months, and make sure that you include cash flow, because that's going to be more important than profit probably over this period of time. So that would be my three sort of takeaways, I guess, there. In terms of reaching out, I'm happy for my details to be circulated via yourself, John. Otherwise, obviously you can look me up on LinkedIn. Happy to have a chat if you've got any questions. Like I said, it's quite detailed, a lot of this stuff, and we've covered it pretty high level, but always happy to have a chat.
Yeah, no, so I appreciate that. So I just also wanted to say in regards to what Ingram Micro are doing, just quickly, while I've got everyone on the call, we're obviously here to support businesses through this time and beyond in Australia, right? We support customers in a variety of different ways, including, through the financial solutions team, things like deferred payments to SME or leaseback agreements. And all of these things are really designed to inject more cash back into our partners. So this, and obviously they preserve the commercial credit facilities that everyone would have for transactional run rate, and that obviously helps with working capital. We're also doing a lot of work with our insurers right now, and working with partners on a deal by deal basis, right? And there's a lot of innovative solutions coming up to helping those partners win those deals, to keep those end users on side. Things like debt assignments and deeds of release are some of the different mechanisms that we use, sort of depending on who the end user is. So if you need additional support, I just wanted to say you can reach out to your account manager, or you can reach out to me directly if you like. You've got my email address because I've sent the invite through to you all directly. So please just reach out to me and I'll connect you in with the right people. So with that, I just want to thank you once again for your time, and Cole for joining me on the webinar this morning.
No, thanks, John, for the opportunity. Yeah, it's been great.
And just keep an eye out on social media and via our communications for other thought leadership events, because there's others in the pipeline. And I'll just wish you all, stay safe and well, and I look forward to hosting you again soon. Thank you very much.
Thanks.